Good morning, everyone. Thank you for joining us today, whether in person or online. As usual, we'll start with a presentation before moving to Q&A. If you're watching online, you can ask a written question by using the toolbar at the bottom of the webcast platform screen. Just select the question icon and you'll be able to type it in. Thank you. So at the start of 2025, we expected end markets to be soft, which proved to be the case, especially in the first half. Encouragingly, we started to see the level of customer order intake improve across our end markets as the year progressed. While revenue for the year declined, we saw 7% growth in the second half relative to the first half of the year. We also delivered an improvement in profitability, where the decisive actions were taken to manage costs as revenues decreased, led to a step up in the operating profit from 4.8 million in the first half of the year to 12.5 million in the second half. We also saw continued strong cash conversion, building on the progress from 2024. By focusing on what we can control, such as supply chain costs and manufacturing efficiency, we've improved gross margins further, whilst also setting up the business to be more profitable as the end markets recover. During the year, we also made some structural changes to our portfolio, announcing the exit from the RF market to allow us to have greater focus on the low and high voltage markets, where we have significantly stronger market position and financial returns. Further, we have continued to invest in innovation and infrastructure, and we're excited about our new business pipeline and the ability to meet greater volumes. On that, I will hand over to Matt to cover our financial performance, and I'll come back to do a strategic update.
Okay, thank you, Kevin. Morning, everyone. So let's move to our normal starting point, which is the full year KPIs. So order intake for the year was 225.9 million pounds. That was up 28% in constant currency, with the growth rate remaining consistently strong throughout the year. Growth was also broadly based across all three market sectors, which was pleasing to see. Revenue was 230.1 million pounds. The year-on-year decline of 11% reported at the half year narrowed to 4% by the end of the year, as our top line gradually improved as the year progressed. Indeed, we returned to modest year-on-year growth, constant currency growth, in the second half as the rate of customer destocking eased and as extra U.S. tariffs were recovered. Adjusted gross margin expanded by 170 basis points to 42.7%. Being able to expand our gross margin in a year of revenue decline not only protected our profitability in the short term, but underlines why we are confident of returning to the mid-40s range as revenue recovers. At interim, we committed to expanding our adjusted operating profit in the second half through internal actions, and this was delivered as planned, leaving full year operating profit at 17.3 million pounds, in line with expectations. I have a slide showing this progress later. We maintained our cash discipline, achieving strong operating cash conversion of 225%. Operating cash generation over the last 2 years has totaled over 100 million pounds, contributing significantly to balance sheet resilience. Net debt closed the year at 41.5 million pounds, or 1.2 times EBITDA. So let's review the income statement in more detail. As I mentioned, full year revenue reduced by 4% in constant currency and by a further 3% due to currency movements, particularly due to a weaker US dollar. We saw a significant step up in order intake as we entered the year, which indicated that our revenue would stabilize, if not return to modest growth as the year progressed. This is indeed what happened. I have a slide showing the H1, H2 split of revenue later. However, the strength of the recovery was inevitably impacted by unexpected developments in global trade in H1. As reported at interim, we therefore took some mitigating cost reduction actions at the time to keep our performance on track. These actions helped to expand our gross margin by 170 basis points to 42.7% for the year. Operating expenses increased by 6% to 80.9 million pounds, with the increase driven by non-discretionary items. Discretionary costs remained under tight control, as I will show you later. Finance costs reduced with lower borrowings and a lower Fed funds rate to 7.8 million pounds, and tax came in towards the top end of our expected range, and with a higher effective tax rate, which simply reflects lower group profits, which naturally increase the risk of unrelieved tax losses arising in individual jurisdictions. We have worked hard to mitigate the impact of this in the year, and we remain confident that the effective tax rate will reduce back down towards the low 20s range as profits recover. All of this resulted in adjusted EPS of 22.5p, nearly all of which arose in the second half. Turning to order intake, the top graph shows the appreciable step up in quarterly order intake as we entered 2025, as I mentioned earlier. The improved level of order intake was maintained throughout the year. We ended the year strongly, particularly in constant currency terms. The bottom graph shows the sectors in which the step up occurred. Growth was strongest within the industrial technology and healthcare sectors as customers prepared to end their destocking activities. Orders from the semiconductor manufacturing equipment sector grew by 10%, with intake strengthening from H1 to H2 amid growing signs of a semi-market recovery. Turning to revenue, you can see in the top graph how the step up in order intake helped to underpin and then gradually expand quarterly revenue. It also expanded by the pass-through of tariffs, which increased as the year progressed. The overall impact was 12% growth in revenue from H1 to H2 in constant currency. Year-on-year growth by sector is shown in the bottom graph. Sales to semi-customers reduced by 7%, but this was against a very tough comparative that benefited from backlog clearance within our high voltage, high power, or HVHP business. Sector growth outside of HVHP was healthy at 8% and weighted towards H2, which is encouraging. As announced a year ago, US export rule changes prevent us from serving China semi-customers upon the expiry of existing export licenses. Sales to these customers totaled 6.2 million pounds in 2025 and will not continue in 2026. Sales to industrial technology customers reduced by 5%, which was the product of reduced sales to OEM customers who continue to destock, but increased sales to distributors whose destocking is nearer completion, particularly in the US. The pace of destocking by OEM customers did slow in H2. Sales to healthcare customers grew slightly despite continued destocking in the first half, as we benefited from strong innovation-driven demand from US medical technology customers. Our gross margin performance was one of the highlights of the year, and the drivers of it are shown at the top. 2025 was a year of revenue decline and therefore reduced utilization of factory overheads. This reduced our gross margin by 40 basis points, but this will of course reverse as revenues recover. The transfer and optimization of production volumes within the group gave us the opportunity to reduce supply chain overheads in our facilities in China and on the US East Coast. We also continue to deliver strong sourcing and manufacturing efficiency savings. Collectively, this added 210 basis points to our margin and was key to expanding our margins year-on-year. Operating expenses increased by 4.7 million pounds to 80.9 million for the year. The first three bars of the waterfall show how non-discretionary costs contributed materially to this. Foreign exchange movements added 0.6 million, less of a headwind than we saw in H1, thanks to steps taken to reduce FX volatility as promised at interim. Accounting entries related to the capitalization and amortization of product development added 2.6 million. Note that the amount that we actually spent on product development remained largely unchanged. The two bars on the right-hand side show how we have managed discretionary costs. Inflation added 2.8 million to the cost base, which cost efficiencies helped to self-fund as shown. The actions underpinning this were disclosed at interim. The actions set out on the previous slide, combined with a gradual improvement in activity levels, drove a significant and expected improvement in profit between H1 and H2, as shown here. Revenue grew by 8.3 million pounds sequentially, or 12% in constant currency, with increased tariff recovery contributing roughly half of this. Gross margins expanded by 250 basis points to 43.9%. Operating expenses reduced by 3% to 39.8 million pounds as cost reductions took effect and FX headwinds eased. Collectively, this increased H2 operating profit to 12.5 million, which is a much better run rate with which to enter 2026. Turning to cash flow, we turned 17.3 million pounds of operating profit into nearly 39 million pounds of operating cash. The key contributor to this was inventory management, with inventory reducing by 20% to 57 million pounds. It is now optimized to current activity levels and therefore should be expected to increase from here as markets recover. Gross CapEx spent on physical assets totaled 7.3 million pounds, of which 6.3 million was spent on the construction of Malaysia. Construction is now complete, and a final payment for the building of 7 million pounds will be paid in H1 2026. We applied for and received US CHIPS Act funding of 1.5 million pounds for our new Silicon Valley Innovation Centre. The strong operating cash generation and March's share placing helped to reduce leverage from 2.3 to 1.2 times EBITDA in the year, which is a resilient position as we enter 2026. Some quick comments on 2026 modeling assumptions. We expect to grow our profits in 2026 with progress weighted towards H2. There are two reasons for this. Firstly, we will see a headwind in H1 as the expiry of export licenses means no further sales to China semi customers, as I mentioned earlier. Secondly, we expect a tailwind in H2 as markets recover, particularly from the wider semi market. We expect operating expenses to grow by circa 5%, including 2% from normalized variable pay as performance improves. We expect the group's effective tax rate to reduce to circa 25%, but as I mentioned earlier, the rate is quite sensitive to profit levels. Cash conversion will remain above 100%, and total CapEx spend should be around 20 million, including product development, which includes final payments for the Malaysia building plus initial fit-out. That's it for the numbers. Now it's back to Gavin.
Thanks, Matt. Before I provide an update on each of our end markets, let me start with a reminder of our strategy. So I just want to take a couple of minutes on our strategy and how the consistent application of it positions XP for a strong future. We've continued to deliver on all elements of our strategy as we and our competitors have navigated the challenges of recent years. Our focus remains on organic growth. We have a market-leading product portfolio, which we have further enhanced in 2025 through new product launches and customer-specific products. Customer engagement levels remain strong for our portfolio, and we remain confident we can deliver double-digit organic growth across the cycle. Our technology solutions teams continue to work closely with our customers to meet their most complex needs and strengthen already strong relationships. Our recently opened Customer Innovation Centre in Silicon Valley is enabling even more collaboration in the critical North American marketplace. This facility has unrivaled capabilities in our marketplace. We continue to invest in our business and our supply chain to ensure we can deliver on our medium-term potential. In 2025, we opened a new design center in Manila, and the Malaysia manufacturing facility build is complete, ready for commissioning in 2026, and we expect the first volume to be shipped in the beginning of the second half of 2026. Users continue to demand more efficient power conversion solutions, and our ability to deliver this is a key pillar of our strategy. We recognize its critical nature for both our customers and their customers alike. While persisting industry-wide destocking headwinds have made the last few years difficult, we have not lost sight of our long-term growth potential. We have deep and enduring relationships with our customers across our three target sectors, which all have attractive long-term structural growth profiles. Our products are designed into their market-leading solutions, meaning when our customers grow, so will we. As many of you have read in some of our customers' recent results, the semi sector is expected to improve significantly during 2026, 2027, and beyond. We are preparing to support this demand and are increasing our inventory levels of critical components based on their commitments. Looking at healthcare and industrial tech sectors, customer inventory levels are clearly approaching normalized levels, and we are seeing increased order momentum, particularly in the industrial tech sector. Across all three sectors, we have continued to make share gains. These have been masked by soft underlying markets, and we've also continued to deepen our relationships with our key customers. By opening the new site in Malaysia, combined with Vietnam, we will have the manufacturing capacity and scalability to ensure we are able to meet demand as it comes through. Lastly, thanks to our leading R&D capabilities, alongside the design-in nature of our portfolio, there's a clear competitive moat for the whole portfolio. Now let's focus on each of the target sectors in more detail, starting with the semis. Okay. This sector remains a great opportunity for us. There are a small number of key customers with whom we have strong relationships, and they have large growth ambitions. Products for this sector are complex, have long life cycles leading to strong customer lock-in, high barriers to entry, and good levels of recurring revenue. These products play a crucial role in a sector that is important in the broader technology and economic landscape, with the increasing use of AI and demand for electronic devices driving this. As our customers attempt to meet this market demand, they are signaling their intentions to substantially increase CapEx, and this is starting to flow through the supply chain to our customers. This is driving forecasts for the wafer fabrication equipment to be up 10%-20% in 2026 as fabs are built out and equipment installed to support the demand for advanced logic and memory. We're starting to see an increase in orders from our customers for both existing and new projects, which is encouraging, and we expect this to improve throughout 2026 into 2027 and beyond. We've also had a number of recent project wins with both existing and new customers that will drive further share gains. We are confident we will continue this trend, allowing us to grow ahead of the WFE market over the medium term as the market fully recovers. So industrial tech. In 2025, industrial tech contributed 38% of the group's revenue, and it's where our distribution customers sit. The sector continues to evolve. Customers require devices that have high power density, are more energy efficient, and have even smarter digital controls, all while being more reliable. This increasing complexity and need for connectivity often requires customized or bespoke products. We are one of the few suppliers in the market who is able to meet these requirements and shorten the time to market for our customers. And it's these type of conditions where XP thrive. While we have faced destocking in this sector, industry levels are now approaching normalized levels and order recovery is underway, with 2025 orders up 34%. We remain confident the market will grow at circa 5%-7% per annum over the medium term, and we will be able to grow ahead of this as we continue to gain share. Now turning to healthcare. The aging global population and constant innovation in the medical technology sector remains catalyst for the long-term growth. While reliability is important in the other two sectors, in healthcare, it is especially paramount. Converters cannot fail. They must meet the most stringent safety and regulatory standards. We are known in the sector for supporting innovation. We're helping to facilitate the latest technology breakthroughs where power is a key differentiator. For example, in pulsed field ablation used for cardiac patients, we are helping customers develop solutions to new levels of control and repeatability. In recent years, we have seen the prolonged destocking post-COVID. We now believe channel inventory levels are approaching normalized levels, so the market is primed for growth and underlying demand remains strong. We're beginning to see evidence of this as our order intake was 48% higher in 2024. Going forward, we expect demand to continue to grow, with the sector returning to growth of between 5% to 7% per annum, with XP continuing to gain share. So I'm talking about the market recovering. What will we see as the market recovers? So over recent years, as we've continued to invest in developing new products and technology solutions, building a resilient, scalable infrastructure, and world-class, efficient customer service across our global supply chain. The results of these investments is that when the market recovers, we are very well positioned to take advantage as customers trust XP to reliably deliver the products and services they require. At XP, we are set up to operate in niches where the products are highly complex, where collaboration and extensive expertise is critical. Customer demand is trending in favor of more sophisticated solutions rather than to less differentiated products, further benefiting XP. Once designed in, our products won't be replaced, and as customer product life cycles increase, so will the revenue annuity for XP. This is across the entire portfolio, from low voltage to high voltage. So given our customers' products are complex, our low voltage product portfolio exhibits the same level of designed-in nature as our more complex medium and high voltage products. Further, by investing in innovation hubs like the one in Silicon Valley, we've been able to get closer than ever to our customers, building trust and helping them develop even more complicated products. This allows us to increase customer penetration, selling more of the XP portfolio than we were previously able to. And by having sites across the world, we are able to meet demand where it is needed. Now I want to turn to our product portfolio and the progress we've made. So for XP to be successful, we have to continually strive to make sure our products are market leading. This is a never-ending process as customers' requirements constantly evolve. This year, we have launched 24 new innovative products with wide-ranging applications. Alongside meeting demands for higher power density and precision, we've designed many of our products with a fully digital architecture. The Flex Pro is a good example of where we have implemented this. This fully digital power supply gives customers access to control and monitor the power supply at market-leading levels of power density. While we believe our portfolio is already market-leading, our engineers continue to focus on innovation to ensure we remain at the forefront of the industry, protecting XP's long-term growth potential. So, as announced in January 2026, we will exit the RF market after the US export controls announced in late 2024 substantially reduced its financial contribution. This left us with a division that had lower margins and returns than the group average. We believe this decision is in the best strategic interest of both XP and our customers, as it enables us to focus on product categories where we have stronger market positions and can have a greater level of product innovation. When determining the best way to exit this market, we engaged with our principal customers to ensure these relationships were protected. The result is we have agreed to exit the market over the next 3 or so years, and we will fulfill their significant final delivery requirements. We also announced in January that we've completed the construction of the manufacturing site in Malaysia and closed the site of Kunshan, China. This is well-timed in view of the expected market improvement, with Malaysia providing XP enhanced capability to service the critical US markets. market. While we still have capacity in our other sites, once operational, the Malaysia site can be ramped up in line with demand, helping us to ensure we are fully prepared. Just want to finish on sustainability. Within sustainability, within our operations and products remains at the center of everything that XP do. During the year, we've continued to make progress with our sustainability agenda. I'm pleased to announce we reached a major milestone during the year where our lost time incident rate dropped to 0. This is down to the team's hard work and dedication to ensuring the safety of themselves and their colleagues across all of our sites. We've made progress to reduce our carbon footprint, with all our EU sites now powered by renewable energy. Finally, our engineers continue to develop products which are more power efficient, and we're using more environmentally friendly packaging where possible to help customers reduce their environmental impact. When we look back on 2025, we took decisive actions with both the short and long term in mind. As we look to 2026, following the expiry of export licenses to Chinese semi customers, there'll be a modest revenue headwind in the first half. With improving underlying demand, we expect progress for the full year with a good tailwind in the second half. Overall, while we remain mindful of the ever-evolving geopolitical conditions, our new business pipeline and product development is strong. We have enduring relationships with our customers, and we have a well-invested infrastructure. This gives us confidence that as the end markets recover, we will benefit significantly. With that, I'd like to thank you all for joining, and I'd open the session up to questions.
Hi, guys. Tom Elgar from Deutsche Numis. A couple from me. I think the first one's just on the cash side. Clearly, you've executed really well over the last couple of years on the cash side. I guess now with the orders turning, strongly and the growth that's coming through, a couple of allusions there to what could be happening on working capital given where we are. Could you sort of give us a flavor of where the kind of, operating window is if we get strong growth the second half of the year in terms of where we could see that in the second half on the first half? The second question, with Malaysia, very, very close to becoming online, and also the sort of statements around the tariff influence within the revenue line. How should we be thinking about drop-throughs this year, given the kind of mix within that and bringing that capacity online? Thank you.
Okay. Cash side. Obviously, as you say, a fairly strong performance over the last couple of years. There was some buffer inventory that we built up during COVID, in the aftermath of COVID, and relevant supply chain constraints that we faced that we've now removed. We're now back to more normal working capital movements from here. You could think of, and I would just say that I set out what overall normal cash flow would look like in the seminar. I'd refer you back to that. In the near term, I would say you could think of it as a working capital to sales ratio of roughly 30% going forward. In terms of drop-through, I would say that if you build that in two components. Firstly, the overheads. We've specifically guided to the overhead growth that we expect in 2026 of 5%. In terms of the gross margin drop-through, you could think of it as us having a fixed overhead base within cost of sales of roughly 18 million pounds today. If you have that, you can then work out the drop-through from there.
Lydia Kenny here from Investec. On the gross margin, you have outlined, I guess, sort of mid-40s target previously. That looks quite achievable given what happened in H2. As, I guess, volumes ramp, how should we think about the progression and what costs should maybe be coming back in?
I will give you the same answer as I just gave. The only element that you need to think about is that, as I say, the fixed element within cost of sales at roughly 18 million. That would obviously give you a drop-through rate, which is greater than our current gross margin performance, and therefore growth is gross margin expanding. you can work it out from there. And the greater the growth, the greater the gross margin expansion. And that's not to say that growth is our only source of gross margin improvement. There is clearly more that we can still do within sourcing savings, manufacturing efficiency gains, etc. So that should continue to come through. There may well be some inflation within the mix too, I think, given what's going on in the world. So we're mindful of that. And in the past, obviously, inflation we've been pretty successful in finding a home for. I'll put it that way. So yes. So I think overall we're happy with the second half performance in particular, and for that reason we're confident that mid-40s would be what we should rightly expect.
One more on, I guess, the new product launches we had in 25. How should we think about it for 26 and innovation as well?
The innovation pipeline still remains strong, and we're expected to carry on with the same momentum that we've got. Remember that because of the designed-in nature, they can often take a couple of years to transform to revenue and then grow from there. But we believe we've got strong momentum ahead in new products that are coming out that are very, very relevant to the market and are actually market leading in a number of areas. So we're quite confident.
Good morning, Tom Rance from Berenberg. 3 questions, if I may. Shall I take them individually just to help you? First one is just, can you expand on the enhanced capability of Malaysia that you referenced at the end there versus the kind of the Chinese site? Is that in terms of revenue and capability?
Well, the first main advantage is it's a purpose-built, self-designed power factory. We inherited Kunshan from a joint venture in Fortran Source. The team were very, very good. We believe because of the location and the dynamics in Malaysia, we can get a very strong team in Malaysia. The second advantage is we can supply the US. We haven't been able to supply the US from many of our US customers would not accept products made in China.
Okay, thank you. Second one was just on the market share numbers you gave in semicon. Only 4%. Maybe I'm being a bit harsh, but that sounds quite low. Is there scope? How has that progressed through the cycle? Obviously, been down in a couple of years, and what scope is there to potentially increase that over the longer term?
So the share is sometimes misleading. It's not the most widely followed market, and often the person who does the work finds more market. So you can grow ahead of the market, but your share can reduce, believe it or not, because they find more market. In semi, there's definite potential to gain market share. There are numerous power supplies on existing tools and on new tools, and so there's opportunities. You get designed in earlier with the core processing to get more and more of it. So we're confident we are gaining share, and confident we'll grow ahead of the WFE market going forward.
Can I just add one point to that? So I think the 4% would include RF. Oh, yes. So therefore, RF, we have a 1% share. So the bit of the business that we're carrying on with has a significantly higher share, 8%.
Great. Very clear. Thank you. On the whole normalization of everything back to pre-COVID levels, there's one glaring thing that's not normalized yet, dividends. What are your thoughts on when you could reintroduce a dividend, given everything's getting back to kind of pre-COVID levels?
Yeah, I think that is a policy and approach that we will consider during 2026 and come back to the market on as we get closer to distributions.
Great. Thank you.
Hi. Morning. Andrew Humphrey at Peel Hunt. Just wanted to think about 26 a bit in terms of end markets and kind of how we perform relative to those. If I look at where sort of street numbers are today, it looks to me as though we're baking in about 7% organic growth for the group. Clearly, RF exit in China looks like a couple of points headwind to that. So, for continuing business, maybe 9% or thereabouts. As I tick through the kind of divisional indicators that you've given in the presentation today, wafer fab equipment growing 10%, 20%, somewhere in that range, you're expecting to do well within that. So clearly, some way above the group average. The other two markets, industrial technology, healthcare, we're talking about kind of 5% to 7% through cycle growth. Probably a bit worse first half, a bit better second half. Overall, maybe we come out in that range. Is that sort of the right way to think about it overall?
I think it is, except for the fact that probably the growth in the semi is going to be a bit second half weighted. So we won't see a full year's worth of that increase in 2026. And that obviously is a significant delta for 2026 as a whole, given how strongly we expect the market to grow.
So just to clarify that, so even X, RF exit, which clearly is first half, or impacts first half more than second half, semis is more second half weighted.
Second half, you can expect semi to be second half weighted, yes, in terms of revenue, absolutely.
And that's widely guided by the industry as a whole. From talking to our customers, that's what they're expecting. There's a lot of excitement in the market and anticipation, and I think it's becoming ever increasing, but it's definitely, see it's going to be Q2, Q3, Q4. Yeah.
Great. Thank you.
Hi, morning, David Farrell from Jefferies. Just sticking to the theme of WFE, can you just remind us what the lead time visibility you have with your customers is in that end market? And I know it's shortened, so kind of how confident are you around the timing of that pickup? What other indications are they giving you?
So there's lead time and then there's indications. So the actual lead time we operate to broadly in the semi market is probably 10 to 12 weeks. But if they can give us longer indications, they will. And that's exactly what they're doing. There's a real push to make sure they can capture all the revenue they can. So they're giving as much guidance and probably in some ways too much guidance about what's coming. So we get a relatively good picture. There's been some issues there's been a problem with one of our competitors who unfortunately had a fire in one of their facilities. That's caused quite a bit of distortion because they suddenly have to redesign other companies in. But then that gives you such an opportunity if you can help customers in this time of challenge. You give a long-term benefit, and that's what we're trying to do.
Okay. My second question is on Malaysia. I'm sure it's not a straightforward thing ramping up a new facility in a new country. So what are the kind of key milestones and key risks there as we look through 26?
The key milestones, we expect to start production in the beginning of the second half. So at the moment, we're at EVP. I spoke to him. He's there this morning, actually, doing fine. We've got people joining as of today, and we're starting to ramp up. They're in Vietnam next week just to see this is what you're going to be doing. So the key developments, the SAP system needs to be completed, which should be relatively straightforward, as it's almost a copy-paste. We're already ordering inventory. We're ordering equipment to be delivered. We will expect to be doing samples in Q3. So some customers will want to approve the site. Others will just approve it as its XP. So we expect to have the first revenue beginning of Q4.
Yeah. Thanks.
And just to add to one thing, that is that from the point of view of our existing Vietnam facility, there is some additional capacity that we will add this year as well to that site. With that additional capacity, the site itself will be running at about 50-55% utilization. So Malaysia is not essential to the delivery of our revenue number in the year that we're currently in. It obviously clearly is beyond that strategically.
Hi, Tom Rance from Berenberg. Just to follow up on that, is there any equipment in China as that closes down that is still kind of relevant that could be shipped over to Malaysia?
Already shipped.
Thank you.
Yeah. So some of the newer test equipment, other things we've put in has already left China, left before the Lunar New Year, and is expected in March.
Likewise, the inventory.
Great. Thank you.
That's Chris. Nothing? Okay. Well, on that note, thanks everyone for joining us, and we look forward to talking to you in the summer.